Welcome back to Charged Alpha Podcasts, the show where we break down S&P 500 names one earnings report at a time. Today we are dissecting Carlyle Companies, ticker CSL.
Fresh off their first quarter 2026 print that hit the tape yesterday on April 23rd, and the headline is Classic Carlyle. Adjusted earnings per share landed well above the street's number.
$3.63 versus the $3.31 consensus, a 9.7% beat worth 32 cents in upside. That is a clean, meaningful earnings beat coming out of the box.
But the top line did not fully cooperate with the narrative. Revenue came in at $1.052 billion against a $1.062 billion estimate, missing by about 1%.
And year-over-year revenue actually contracted 4% when measured against the Q1 2025 print of $1.096 billion, which complicates the otherwise clean earnings quality story we will dissect.
Shares closed at $363.70, sitting roughly 17% below the 52-week high of $435.92, with a market cap around $14.9 billion today.
So the setup today is EPS beat, revenue miss, stock meaningfully off the highs, and a portfolio freshly transformed into a pure-play building product story. Plenty to unpack across the 13 sections. Let's start with background, because the Carlyle you might remember from 5 years ago is genuinely a different company than the one reporting earnings today, and that reframe matters enormously for investors.
Carlyle traces its roots to 1917, originally a rubber products maker in Pennsylvania, and the Scottsdale-headquartered business has spent the Vision 2030 era reshaping itself into a focused building products pure play.
This business has been around for more than a century, and those origins tell you something about the industrial DNA that still shapes the way management thinks about products, customers, and capital allocation.
CEO Chris Koch took the reins in 2016 and has been the architect of that transformation, divesting the CIT segment in 2021, CFT in 2022, and CFS in 2023 to simplify the portfolio. What remains are two reporting segments that share industrial DNA: commercial roofing through Carlyle Construction Materials and weatherproofing technologies, both leveraging the same contractor networks and the same specification-driven sales motion at the architect level.
Roughly 5,500 employees now, a tightly focused operating model, and a management team that has explicitly promised to return every dollar of excess capital back to shareholders over the medium term.
That capital return discipline is a theme we will keep coming back to today, because it is arguably the single most important variable driving the forward earnings algorithm at this transformed, pure-play building products entity.
Turning to the top line, the 8-quarter revenue trend tells a very clear seasonal story that investors newer to the name absolutely need to internalize before drawing any strong conclusions about quarterly prints.
Starting in Q2 2024 at $1.451 billion, then Q3 2024 at $1.334, Q4 2024 dropping to $1.123 billion as winter kicks in seasonally.
Q1 2025 came in at $1.096 billion. Then Q2 2025 rebounded sharply to $1.45 billion. Q3 2025 at $1.347 billion on continued commercial install activity.
Q4 2025 registered $1.128 billion, and now Q1 2026 at $1.052 billion. The pattern is unmistakable. Q2 and Q3 are the peak roofing install windows every single year.
So the 4% year-over-year decline in Q1 needs serious context. You are comparing the seasonally weakest quarter against itself, and the delta clearly reflects genuinely softer commercial construction volumes in the current cycle.
Management attributed part of the softness to elongated project timelines and selective channel destocking, not a structural demand break in end markets. That distinction matters enormously for the bull versus bear framework we will develop today.
The key question for modelers is whether Q2 and Q3 snap back to the historical seasonal pattern. If they do, full-year revenue can still print roughly flat despite the weak opening quarter. Moving to earnings, the Q1 beat breakdown is worth parsing carefully block by block. Adjusted EPS of $3.63 versus $3.31 estimate, a 32-cent beat, and up 10% year over year.
The beat came from a combination of gross margin expansion, disciplined operating expense control, and meaningful share count reduction from the quarter's $250 million repurchase program execution during the period.
On a forward EPS projection basis, Consensus is looking for $20.18 for full year 2026, rising to $22.95 in 2027 and $27.14 by 2028 fiscal year.
That 3-year compound growth rate implied in the forward curve is roughly 16% annually, which frames how the market is thinking about Carlyle's post-transformation earnings power and capital return algorithm going forward.
Every forward EPS projection embedded in that analyst curve assumes continued buyback execution, stable pricing, and a Q2, Q3 seasonal recovery that has historically been very reliable for this name across most construction cycles.
The trailing 12-month EPS of $17.77 puts the stock at a 20.5 times trailing price-to-earnings multiple, with forward 2026 compressing to roughly 18 times.
Worth noting, the GAAP versus adjusted bridge was relatively clean this quarter. Carlyle's adjustments primarily related to restructuring charges and amortization of acquired intangibles, which is standard post-divestiture accounting hygiene for this name. Gross margin is where Carlyle's transformation story really shows up in the numbers, and the Q1 picture requires a careful seasonal lens to interpret correctly without drawing false conclusions about the underlying franchise.
Q1 2026 gross margin printed at 29.5%, operating margin at 17.3%, and EBITDA margin at 24%, despite operating through the seasonal revenue trough this quarter.
That 17% operating margin looks optically soft, but it reflects fixed cost deleveraging in the slow quarter. The trailing 12-month operating margin is a much healthier 20.1% on blended revenue.
Trailing 12-month gross margin sits at 28.3%, net margin at 14.6%, and return on equity comes in at 41.3%, which is, frankly, elite for an industrial compounder.
The margin profile is a direct consequence of the Vision 2030 divestitures. By exiting lower-margin businesses in CIT, CFT, and CFS, the residual portfolio structurally earns more per dollar of revenue than the pre-transformation entity ever did.
And importantly, pricing power held through Q1 despite the clear volume softness in end markets. That is the tell investors should focus on. Carlyle is holding price in a weak volume quarter, not acting like a commodity.
The margin outlook for the balance of 2026 depends heavily on whether raw material inputs stay benign. Polyiso, steel, and freight costs have all moderated, giving Carlyle a favorable cost tailwind heading into Q2.
Cash flow in Q1 looks ugly on the surface at first glance, but again, the seasonal lens is doing all the work in interpreting these numbers properly for a building products business with install season dynamics. Q1 free cash flow was negative $73 million, with operating cash flow at negative $45 million and capital expenditures of $28 million, all classic seasonal working capital build ahead of Q2 roofing install season.
Zoom out to trailing 12 months and the picture flips entirely. TTM free cash flow sits at a positive $922 million, a very robust conversion figure relative to reported net earnings for the period.
That 922 TTM FCF figure is what funds the capital return program. Carlyle deployed $250 million in Q1 buybacks alone, repurchasing shares despite the stock still sitting off its highs.
The buyback pace matters enormously for the per-share math. At $250 per quarter, annualized that is $1 billion in repurchases against a $14.9 billion market cap, a roughly 7% annual reduction pace.
Skeptics will ask whether buying back stock at $363 is the right use of capital given commercial construction cycle risk, and that is a legitimate debate we will absolutely revisit in the bear case section.
For modeling purposes, assume Q2 free cash flow rebounds sharply as working capital unwinds with install volumes, with full-year FCF likely landing in the $900 to $1 billion range if seasonality cooperates.
The balance sheet is the quiet strength of the Carlyle story, and it gives management the flexibility to be aggressive with capital returns through cyclical troughs, without ever stressing creditors or credit rating agencies on leverage. Cash and equivalents stand at $771 million, total debt at $2.882 billion, net debt of $2.111 billion against trailing EBITDA just over $11 billion.
Net debt to EBITDA of 1.8 times is comfortably investment-grade territory, and interest coverage of 10.87 times means debt service is a complete non-issue operationally, even through a cyclical downturn.
Total assets run roughly $5.9 billion, equity around $1.6 billion, and the capital structure is deliberately built to absorb cyclical volatility while sustaining shareholder returns uninterrupted through both peaks and troughs.
The debt load is manageable precisely because the divested businesses financed the strategic pivot. Carlyle essentially used M&A exit proceeds to fund the transformation rather than levering up aggressively against operating cash flow.
That matters a lot for downside modeling. In a severe commercial construction downturn, Carlyle has the liquidity and coverage ratios to maintain dividends, fund buybacks, and invest through the cycle without any issues at all.
The debt maturity profile is also well-laddered with no near-term walls to refinance at higher rates, which removes another common cyclical stress point that often complicates industrial names operating deep into a rising rate environment.
Speaking of dividends, Carlyle is a quiet dividend aristocrat. The current $4.30 annual dividend yields 1.18% at today's $363 share price, which is modest on a standalone basis. But the real story for income investors is the streak itself. 47 consecutive years of dividend growth, placing Carlyle in a very exclusive club of compounders with multi-decade capital return discipline and zero cuts.
And the buyback is doing serious heavy lifting on the per-share math for total return investors. Diluted share count has dropped from roughly 47.9 million in 2022 to 41.1 million today.
That is a 14% share count reduction in under 4 calendar years, meaning every dollar of net income is now spread across a meaningfully smaller base, mechanically lifting earnings per share even absent volume growth.
When you combine 47 years of dividend growth with a 14% share reduction in 4 years, the total shareholder yield on this name quietly approaches high single digits annualized, which is real.
Management has essentially told the market they view excess free cash flow as shareholder property, and the capital allocation track record under Koch's leadership since 2016 backs that explicit commitment with consistent, disciplined execution quarter after quarter.
One underappreciated dynamic is that the buyback program has effectively retired more shares than the company issues in equity compensation, making it genuinely accretive rather than simply offsetting dilution, as many industrial peers unfortunately do today.
Turning to the sell side, Consensus is cautiously constructive on the name. 4 buys, 3 holds, 0 sells, with an average price target of $425, implying 16.9% upside from current levels. Recent actions skew positive on the tape. Oppenheimer reiterated Outperform in April 2026. Baird reiterated Outperform in April. JP Morgan maintained overweight in March, and Goldman Sachs carries a buy rating into the print.
On the cautious side of the ledger, Loop Capital downgraded to hold last July, citing valuation and construction cycle concerns, and Truist also sits at hold, so the analyst debate is genuinely two-sided right now.
The dispersion of views reflects a real fundamental question. Is Carlyle a quality compounder deserving a premium multiple, or a cyclical industrial vulnerable to a volume air pocket in commercial non-residential construction this year?
The 425 average target implies analysts think the market is underappreciating the post-transformation earnings power, but it is not a screaming consensus long call by any reasonable sell-side standard today.
Against peers, the valuation positioning is clear once you line them up. Lennox trades at 22 times, Carlyle at 20.5, Masco 17, Owens Corning 16.5, Builders First Source at roughly 13.5.
So Carlyle sits at the premium end of the peer set, but below Lennox, which reflects the market's willingness to pay up for the transformed portfolio story without yet awarding it the full best-in-class HVAC multiple.
Let's dig into the segments now because understanding the CCM versus CWT split is essential to grasping where Carlisle actually makes its money and where the real pricing power and competitive moat truly reside. Carlisle Construction Materials, the CCM segment, is roughly 85% of consolidated revenue. Commercial roofing, TPO membranes, EPDM systems, PVC membranes, and polyiso insulation products sold through deep contractor networks built over decades.
The moat in CCM is fascinating and durable. Carlisle Syntec runs one of the largest contractor training and certification programs in commercial roofing, creating real switching costs at the installer level that translate directly into pricing power.
And critically, around 70% of commercial roofing spend is re-roofing, not new construction volume. That makes the demand profile much more resilient through construction cycles than the headline non-residential exposure might initially suggest to investors.
Weatherproofing technologies, the CWT segment at 15% of revenue, covers sealants, water barriers, and air barriers with higher residential exposure than CCM's commercial-dominated mix and a different growth profile historically than the roofing side.
CWT has historically been the higher growth, higher margin piece on a percentage basis at the gross line, but it is small enough that CCM execution still drives the consolidated story quarter to quarter for investors.
Key competitors include GAF and Firestone Building Products on the commercial side, both privately held, plus public peers like Owens Corning, Sika in Europe, and Tremco under the RPM International umbrella on the specialty side.
The competitive dynamics favor scale in this industry. Carlisle, GAF, and Firestone effectively form a three-firm oligopoly in commercial single-ply roofing membranes, which is precisely why pricing has held up so well through prior cycles.
Now to the bear case, because the stock sitting 17% below its 52-week high tells you the market has real concerns worth articulating carefully and honestly before any investor decides to step in at current levels.
Bear concern one is commercial construction volumes softening. ABI indices have been soft, non-residential starts are decelerating, and the Q1 revenue decline of 4% is evidence the volume air pocket is real and currently ongoing.
Bear concern 2 is tariff exposure on polyiso insulation inputs and steel-related components, which could pressure gross margins going forward if Carlisle cannot push pricing fast enough against rivals in the commercial contractor channel.
Bear concern 3 is valuation risk. At 20.5 times trailing earnings, Carlisle is priced for continued execution, and any multiple D rating combined with a future earnings miss would compress the stock price materially and quickly.
Bear concern 4 is capital allocation timing risk. Spending $250 million on Q1 buybacks, with the stock still at elevated levels, could prove poorly timed if shares re-rate meaningfully lower from here over coming quarters.
And bear concern 5 is the overall setup itself. Stock already off the highs, revenue shrinking year over year, valuation premium to most peers, and late cycle positioning, which is genuinely not a layup long thesis today.
The bull case rests on a very different reading of the same fact pattern, and it starts with the observation that Q1 is structurally the weakest quarter for Carlisle's roofing-heavy end markets by a wide margin.
Bull point 1 is seasonality itself. Q2 and Q3 are historically the peak roofing install windows, and the sequential revenue ramp from Q1 to Q2 has typically been 35 to 40% in normal operating years.
Bull point 2 is pricing power confirmed this quarter. Gross margin expanded year over year despite clear volume softness, which is exactly the signature you want to see in a quality industrial compounder with real brand strength.
Bull point 3 is the buyback flywheel compounding. 14% share count reduction in 4 years mechanically compounds EPS, and at roughly 18 times forward earnings, the per-share math gets interesting very quickly for patient holders.
Bull point 4 is the 17% discount to the 52-week high sitting right in front of us. If the forward EPS trajectory holds, the current entry point offers a genuine re-rating opportunity back toward prior highs.
Bull point 5 is the portfolio itself post-transformation. A pure play 41% return on equity building products business with a 47-year dividend growth streak deserves a premium multiple in most market regimes historically.
CEO Chris Koch framed the quarter this way on the call. Quote, Carlyle's results this quarter reflect the power of our transformed portfolio, a focused, high-margin building products business with pricing discipline and real operational excellence.
He continued, and a commitment to returning every dollar of excess capital to our shareholders. End quote. That framing is effectively the entire bull case distilled into a single concise sentence from the Chief Executive Officer.
Net takeaway for the name today: EPS beat, revenue soft, capital return aggressive, valuation full but not fully stretched, and the Q2, Q3 seasonal setup will determine whether this becomes a re-rating story or a dead money year.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall